Between March 30th and April 17th, the Russell 2000 bounced 14%. For most investors, noise. If you just retired in January, the scariest 3 weeks of your financial life. Today, sequence of returns risk, the biggest threat to a retirement portfolio, and the one nobody talks about until it's too late.
Welcome to Leibel on Fire with Amazon best-selling author and Yields for You portfolio manager, Leibel Sternbach. Leibel on Fire is supported by our ETFs, Yields for You Strategy A and Relative Strength Managed Volatility. Our mission is to help 1 million people retire with financial security. Now, the Financial Independence and Retirement Show dedicated to helping you build the life of your dreams as fast as possible with as little stress as possible. It's Leibel on Fire.
Hi, everyone, and welcome back to Leibel on Fire. And Leibel, I've got some questions for you with a sequence of returns, risk, in real time. First, let's talk about the definition of the sequence of returns.
Yeah, so as the name implies, right, the risk is that you're going to get your returns in the wrong order. And so the analogy that anyone who has met with me or gone on any of my webinars has probably heard is this, right? In retirement, the rules about money fundamentally shift, right? During our working years, the name of the game is invest and, dollar cost average and just keep putting money into your 401k, because fundamentally, the longer that you keep it in the market, the more money you're going to make. And I have this great chart that you can find on our website, right, where it shows two investors, right, both start with the same amount of money, both end with the same amount of money, but they take two very different paths to get there, right? Because while we're investing in the market and we keep our money in the market, the order that we get those returns doesn't matter, because that's how multiplication works, right? It's whether you multiplied, 10 times 10, or 10 times 5 or 5 times 10, you're going to end up with the same answer, right? And that's what the math of investing in the market kind of does, is that, you get your average returns, right? The average is going to be the same. The problem is that in retirement, when we start pulling money out of our portfolio, when we're taking income out of there, all of a sudden, those losses can compound. It's kind of like riding a bicycle downhill. The steeper the hill and the faster we're pedaling, the faster we're going to go. And if we don't start pumping those brakes, we're going to end up splat at the bottom of the hill. And so those same two investors, right, both starting with the same amount of money, but now they're taking income, right? Even a modest $50,000 a year adjusted for inflation. Let's say you start with $1 million. If one investor gets, all the good years of the last, 25 years of the market, right? They start with the good years, and the other investor starts off with bad years. What happens, right? One investor ends up almost tripling their money. The other investor will go broke by the time they're 78. Right, within about 14 years. And the simple reason for that is because one investor is taking income when the market is down in the beginning, and the other is taking money when the market is out. All right, so sequence of returns risk is the risk that we are taking money out of our investments when the market is down, and we're then compounding those losses. And just, kind of simple math example to kind of illustrate this. Let's say you've got $100, right? And you're taking out, $10 for income. Well, if the market goes down by 10% or 20%. So let's say a 20% loss, right? Market goes down by 20%. So our $100 is now $80. Sure. And then we're taking $10 for income. Well, our portfolio is now $70. And the next year we still need our $20 of income. That hasn't changed. So now we're at $50. Our portfolio is halved in value, even though we were only taking 10% of income. And you can make those numbers whatever you want. The point is that it's compounding those losses. And now all of a sudden, in order to get back to even, you have to double your money, right? You're 50, you got to get 100% return. So your $50 needs to become $100. And that, none of us are taking that risk in retirement, right? We're not investing in a way where our money is going to be able to double in any kind of reasonable time frame. And so when we look at our investments, what we need to make sure is we need to make sure that we have an income plan. We have a plan for what happens if the market is down when I need that income? What happens if the market is down for more than 3 or 4 months? What if it's down for 18 months? What if it's down for 2 years, 3 years, 5 years, 10 years? Because the market has historically done that in the past. It has taken years to recover, to come back to its, high point. If you retired right before the Great Recession, you wouldn't have your money wouldn't have been even until 2012, let alone what would have happened if you had been taking those withdrawals. Because I can tell you right now, right? Like, you would have been calling me up and you would have been like, Leibel, I'm really scared. I need to have a lifestyle change. And so the one thing that I really, if you take nothing else from all of the shows and all the resources and everything that we put out here, it's make a plan so you don't have to have a lifestyle change, right? Because that is the worst possible thing, is sitting there pinching pennies, wondering how you're paying your bills when you have no ability to work, either because your skills and you've been out of the workforce for so long, or because, God took it out of your hands, right? You're yourself and you got some injury and now you can't go back to work. And who the hell wants to go back to work when you've been retired for any amount of time?
That makes sense. So talk about that new retiree. How were they impacted when the markets fell back in March and then bounced 14%?
It really depends on whether they had a plan or not, right? Market went down 14% if you were in the Russell, 7.5% if you were in the S&P 500. Very few people are just owning the index. Even the people who are index investors, they generally have other stuff, right? And there were stocks that were down 20, 30%. So for a retiree, right, you got one, high inflation, and then two, high gas prices, right? And then three, you have these losses. If you didn't have a plan where that money was coming from, not only are you spending more than you were anticipating, but you're pulling it from a portfolio that is at a lower value. And I can tell you this right now, if you didn't have a plan, you were struggling. You were wondering, you were worrying about the market, you were keeping up at night. Now, it is a double-edged sword because, like, as we talked about, the investing world has gotten a lot more volatile. And so you have a lot more of this quote unquote irrational behavior, and it's being driven by people who are doing things based on, they're buying option contracts based on their belief of what it should be and what the future should be, not based on, any hard evidence, right? Like, the market has recovered from this Iran conflict, even though it's not over, even though there is absolutely billions of dollars of damage done to oil infrastructure, and that's going to take years to recover from. But the market's acting like nothing happened. The two can't be true. There has to be a reckoning.
Interesting. We're talking with Leibel Sternbach about the sequence of returns, risk, in real time. And I'm just wondering, why are the first 5 years of a retirement more dangerous than the second or the next 20?
Yeah. So in those first few years of retirement, so the first few years prior to retirement, the first few years of retirement are the most dangerous. And the reason for this, number one, is the sequence risk, right? Because you're decreasing that portfolio value. You may or may not have started taking Social Security. You have a whole lot of expenses and you don't know what those expenses are. And you are in the longest time period for your retirement. And so any bad decisions that get made, right? They may not impact you immediately, but they're going to compound over time. Right. And they're gonna, so you have a few bad years in that first few years of retirement. Yeah, you're not going to run out of money in the next 5 years. You're not going to run out of money in the next 10 years. But guess what? You're going to not run out of money in 15 years, maybe 20 years. And that's the difference between, living comfortably for the rest of your life or getting to the end of the road and being like, I can only afford to, bread and tuna fish because, I ran out of money because I didn't steward my resources correctly, right? By the same token, not investing aggressively enough can have a similar type of problem, right? And so people will come to me with two sides of the same coin, right? Some people, I tell them, hey, you need to take less risk in your portfolio because what we need to make sure is that when the market is down, we have money to spend and we're not having a lifestyle change. We're not cutting back on our spending because we don't want sequence risk. By the same token, some people, they come to me and I'm like, listen, you're going to be fine for the next 5 years, but you need to get more aggressive because I'm worried about when you get older. I'm worried about when, you trip and fall and you need to replace that hip or whatever, and you need rehab and we need to spend $50,000 or just inflation catches up to us and Social Security is not keeping up. Your money is going to run out. And so sequence of return, right, is a real threat, and it can bite us in the butt, on the front end or on the back end, depending on how we're positioned financially. Either way, it still hurts. And I'm wondering, and I think the answer might be depends.
Can you tell how much cash a person should keep on the sidelines to avoid selling stocks in the downturn market?
Yeah, so I'm not a big fan of keeping cash on the sidelines, because you need your money to make money, and so you need to, at a minimum, have money in something the equivalent of high yield savings. But really, you need to take on a little bit more risk, right? Because this becomes the issue of, okay, so I took all the risk off the table, but then 10 years from now, inflation catches up to me, and my buying power is decreased, and I'm struggling to pay taxes. I'm struggling to pay, to buy groceries because nothing has kept up, right? So what I recommend, right, and we have tools on our website. We have the 60-second retirement calculator you can go through. We also do our, retirement tax SWOT analysis. So what I recommend is go on our website, put in your numbers, plug in your numbers, and it will give you our 321 retirement plan, right? So it'll lay out the money in 3 buckets. The first bucket is the money that you're going to be spending over the next 1 to 3 years, right? So you want to make sure that's pretty liquid, while still taking on a little bit of risk so that you're getting more than inflation, right? You want that money to at least keep pace with inflation. And then that second bucket is what happens if the market's down for more than a few years, because it can happen. But again, we want to take on more risk, right? We need, if the market is, mediocre, or even if the market's in a bull market, we need to make sure that this money is growing. But we don't want that if the market's down for 5 years that we're taking more than a 5 or 10% hit on that money, because then we have sequence risk again, right? So you want to have that second bucket, and then that shields our third bucket, which gets to be our growth bucket, right? That we get to take on the full market risk, or whatever it is that you're comfortable with, or whatever your plan requires you to take on in order to not run out of money. And so in terms of, how much cash, go use that system. It is an algorithm, right? So it may not be tailored exactly for your needs, but it'll give you an idea. And then on that page, there's be a link to our calendar to book a time. More than happy to look that over, give you our 2 cents, tell you what we think you should do based on your unique situation, and, kind of walk through those decision process. But you should definitely have some sort of cash plan in place so that when the market is down, because I can guarantee you the market will be down, right? 5% corrections happen every 3.5 months, right? 10% corrections every 18 months, if not sooner, 20% greater corrections every, 3.5 years. And those seem to happen almost once a year now. So, statistically, you're going to have these corrections. You need to be able to recover from them. And so you need to have the money on the sidelines, right? And that's just the cost of having peace of mind and not running out of money in retirement.
That website is yields4u.com, yields, the number 4, the letter u.com. So the retiree finds himself having to take the required minimum distributions in a downturn market. Should they delay or change how that money is coming out?
This is, again, one of those insidious things of RMDs and taxes, right? It's, as the old saying goes, if failure to plan is, planning for failure, and the IRS is sitting there with your plan, right? So if you don't make a plan, the IRS got one for you, and it's never going to be to your liking. And this is one of those ways, right? A lot of people I'll meet with, they're like, whatever, the RMDs, I'm not so worried about it, right? It's how much I need to live off of anyways. It's a little bit more, whatever. I have to take $50,000 a year out of my RMDs. It's, I pay the taxes. I don't want to pay the taxes, but I'm not worried about it. The thing you should be worried about is the sequence risk, because you got to take that money out of your retirement account, whether the market is up or whether the market is down, right? You don't get to control when you take that money out. Within the 12-month period, you can decide when, right? And so I have lots of strategies. I talk to people about how to make that more advantageous for you. But if you don't have an income plan, that RMD can be a silent sequence of return risk. You did everything else right, but the RMDs cause you to run out of money. And guess what? The IRS couldn't care less, right? Like, it's short-sighted by Congress, but the plan is for you to drain your retirement account while you're still alive. And sequence of return risk, they don't care whether it's because of sequence of return risk, or because you're taking it out for RMDs, or because, Medicare is not keeping up and Social Security is not keeping up with your expenses.
We're just about out of time, but what separates a retiree who runs out of money from those who don't?
planning to fail versus failure to plan, right? If the ones who have a plan, right, who do the upfront hard work of making sure they have an income plan and not just writing a check to an annuity company and being like, oh, I'm outsourcing my concerns. You can't outsource your worry. You need to be a partner with your financial advisor. And the retirees who take the time to set themselves up right are the ones who don't run out of money in retirement. The ones who are passive, I guarantee you, right, no matter how much money you have, they usually end up with zero.
I don't know if I should say thank you for that, Leibel, or not, but thank you very much for that, Leibel Sternbach. And if you'd like to learn more, you can go to yields4u.com, yields, the number 4, the letter u.com. When you're working, a 20% drop is a buying opportunity. When you're retired and pulling income, we've learned today, it's a permanent dent. The retirees who weather it out have a cash cushion, a flexible withdrawal plan, and a portfolio built for the first 5 years. Now, if the last 3 weeks made your stomach hurt, and I know it did mine, have the conversation right now, not during the next drop. For Leibel Sternbach, I'm Freddie Bell, and this is Leibel on Fire.
If you would like to see how the Yields for You team can help you get off the Wall Street roller coaster and save you money on taxes so you can live the life of your dreams, book an appointment online at yieldsforyou.com or call 410-914-4894.
Yields for You is a registered investment advisor in the state of New York and only transacts business in states where the firm is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell or solicitation of any offer to buy or sell the investments mentioned. Annuity guarantees are subject to the claims-paying ability of the issuing insurance company. Content should not be viewed as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation.